ChatGPT is arguably the most successful software rollout in modern history. Yet, beneath the pristine interface, the frontier artificial intelligence industry is igniting cash inside a financial black hole. Under the leadership of CEO Sam Altman, the company achieved growth metrics that most tech firms take decades to reach. To see the scale of the contradiction, we have to look at OpenAI's 2025 revenue. They brought in $13.07 billion, driven largely by 50 million paying ChatGPT Plus subscribers. But that success is eclipsed when we factor in their spending. That $13 billion milestone is buried by an inverted red bar representing a GAAP net loss of $38.53 billion for the exact same year. A consumer software company can usually thrive on $13 billion in revenue, but when your product requires thousands of specialized supercomputers just to generate a sentence, those subscription dollars disappear before they ever reach the bottom line. To lose nearly $39 billion in 12 months, a company has to spend at an enormous scale. In 2025, OpenAI's operating expenses hit $34 billion. This area chart breaks down the two primary drivers of that spending. First, OpenAI burned $19.18 billion on research and development to build the next generation of models. Second, they spent $7.5 billion exclusively on compute costs, the physical electricity and processing power required to answer prompts. The financial forecast offers no immediate relief. Moving into 2026, data projections show a cash burn rate dropping another $27 billion into the negative. $20 monthly subscriptions cannot cover the hardware bills required to train artificial general intelligence. To survive, OpenAI had to rewire its entire business model. The first tactic to close this gap was straightforward: squeeze the existing consumer funnel for every possible dollar. In December 2024, they launched ChatGPT Pro at $200 a month. The goal was to extract 10 times the revenue from heavy enterprise users who needed higher computation limits. But as this split graphic shows, the subscription model has a structural ceiling. 98% of all AI queries are free and informational. That means the vast majority of server usage generates no direct revenue, while still burning millions in electricity. To monetize that massive 98%, OpenAI launched a self-serve advertising network inside ChatGPT, allowing brands to bid for placement beneath AI-generated answers. This transition turns OpenAI into an attention merchant. By charging advertisers for access to free users, they are now selling audience eyeballs to cover their computing deficits. Unlike traditional search engines, the ChatGPT ad network abandons keyword targeting. A user asking an AI for advice doesn't speak in fragmented keywords, so the system requires a different trigger. Instead, the system uses context hints. This abstract flow diagram illustrates how it works. Advertisers write plain language descriptions of their products, which then dynamically intersect and lock together with the conversational context of a user's prompt. The pricing operates on a self-serve auction, with a cost-per-click model between $3 and $5, alongside outcome-based cost-per-action testing. But injecting sponsored content into an AI's output carries immense risk. The value of a generative chatbot relies on the user trusting the objectivity of the answer. Blurring the line between an impartial response and a paid placement gambles with that core trust. Generating advertising revenue means very little if your expenses remain uncapped. That required a difficult intervention with their primary infrastructure provider, Microsoft, and its CEO, Satya Nadella. In April 2026, the two companies renegotiated their alliance. OpenAI successfully capped its total revenue-sharing payouts to Microsoft at $38 billion through the year 2030, a massive reduction from previous projections. They also forced a second strategic concession, breaking Microsoft's cloud exclusivity. This allowed OpenAI to shop around and deploy its services on rival platforms to find cheaper computing rates. OpenAI forced these concessions from its largest partner because the alternative was a total collapse of their future cash flow. Even with capped expenses, OpenAI still couldn't cover the multi-hundred billion-dollar price tag of its ultimate goal. They needed Wall Street, and that meant addressing their corporate structure. Take a look at this corporate structure diagram. In October 2025, OpenAI morphed from a complex capped profit subsidiary into a Delaware-based public benefit corporation. The new layout distributes ownership entirely differently: 47% to investors, 27% to Microsoft, and 26% to the original foundation. Most importantly, it removes the profit ceiling for investors. The original nonprofit foundation retains that 26% stake, valued around $130 billion, to maintain a formal, legal connection to the company's founding humanitarian mission. By abandoning the capped profit model, OpenAI removed the final institutional barrier preventing massive public capital from entering the system. The path to an initial public offering was cleared. The scale of the hardware infrastructure OpenAI intends to build with this newly unlocked capital is staggering. The centerpiece is the Stargate initiative, a $500 billion plan to build 10 gigawatts of new data center capacity across the United States. To bring those hardware costs down, they're designing custom internal silicon. Codenamed Jalapeno, this custom AI inference chip is engineered specifically to slash their $14.1 billion computing bottleneck in half. The financial endgame for this restructuring is a Wall Street debut. Financial analysts projected 2027 IPO, targeting a post-IPO market cap of $860 billion. Building AGI has evolved from a computer science problem into the most extreme feat of financial engineering in modern history. Sustaining the massive deficits required to train it has turned a research lab into a global corporate power.